Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young, and welcome back to What We Learned in the Markets This Week. So, should we sell in May and go away? Well, not so much. There is no rhyme here, but what you would have actually preferred was to sell in April and go away. Now, there is no way to time and control the market or the economy. You never know what news cycle is just around the corner. Thus, your best superpower as an investor is consistency. Let me say that again. Your best superpower as an investor is consistency in the market, or as our friends in the behavioral finance field say, time in the market. So before we look at the markets, let's review our weekly roundup of economic data that we review to see how the economy is doing and how that might impact the market. First, each week we look at the Atlanta Fed's GDP Now model for a gauge into the growth of the economy. I don't know how much the market watches this report, but if the market does, and when I say market, I mean market participants and all the algorithms that trade based on economic data like this as it's released. But this thing blew up in a good way last week, and maybe that's why the market had a good week. After reports from the U.S. Bureau of Economic Analysis, the U.S. Census Bureau, and the ISM, the growth of our economy in real time is showing at 4.2% growth. That would be a major surprise to the upside, considering what economists currently anticipate, which is typically always starts lower and then grows throughout the quarter as they become more optimistic. But they're only estimating about a 2% growth right now, and we're showing 4.2. So a wonderful report here from the Atlanta Fed, and just a great report. Let's see if it sticks around. Here's another set of numbers that really took a jump in the consumer's favor for the better. And those are the 15 and 30-year mortgage rates. They got some much-needed relief, dropping to 7.09% on the 30-year version and 6.38% on the 15-year version. So just as you can see, not anywhere near the January lows that we saw, but finally nice to see those rates going in the right direction, down for consumers. How about the front end of the labor market? How is it doing? Well, we can tell this by looking at the initial claims for unemployment insurance, something we'll dive into in point number 4 a little bit deeper. But for right now, let's just talk about this number, which is released weekly, took its first major jump to the upside in the last few weeks, coming in at 231,000 initial claims for unemployment insurance. Now, to put this in perspective, you can see while the jump was huge, we're still sitting below the 1-year backwards-looking highs. So still well within a good number, despite the surprise to the upside. But one piece of evidence we can use to prove our lack of worry about the initial claims for unemployment insurance are the continuing claims for unemployment insurance. And those are the folks that are on unemployment insurance that are not able to get off of it. So they go onto it and they're just stuck on there because they can't find a job. Those have even taken a dive down this year, despite a pickup this last week. So those numbers looking pretty good. And so the labor markets, while not as piping hot as they were last year, and we talked about this when we discussed the JOLTS report last week, the cooling down is actually what the markets wanted to see, a cooling down or a soft landing, if you will, hence all the soft landing talk. And finally, the markets, probably why many of you are here. What did the markets do this week? Well, first we look at the S&P 500, which is our proxy for growth and growth in income, but only when considered together, and that was positive 1.85% this week. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive 1.19% this week. And finally, the MSCI EAFE, which tracks developed stocks across the globe, excluding the United States, that was positive 1.8% this week. So the S&P 500 wins the Kentucky Derby. Point number 2, we're down to the home stretch of earnings season for publicly traded companies. So let's do another check-in after we looked at this last week as well. The big boy left to report is NVIDIA, and they're not going to actually report their earnings until May 22nd. So we have about 2 weeks, week and a half to watch for them. But at this point, 92% of companies have reported their first quarter earnings, according to FactSet. Companies have exceeded their earnings estimates by about 7.5%, which, as we discussed last week, is better than the 10-year average of 6.7% beating on earnings. Only 59% of the companies beat on the revenue side, which is where you could argue earnings season has been a disappointment because the 10-year average for beating on the revenue side, top line, is 64%. The market has responded well to the earnings or the profit beats and hasn't really punished us for not beating on the revenue side as much. Now, why is that? Well, companies are doing what they should be doing, which is improving their margins if top-line revenues are coming in a little softer. All the layoffs we're hearing about, one example, not a bad thing of the layoffs if it allows a company to continue to keep the bottom line growing. And the job market is so robust right now that if you're a displaced worker, you're able to find work pretty darn fast. The chart you're seeing on your screen shows the margins improvement by S&P 500 companies coming in on average at 0.1% better. The best sector has been utilities, and the worst was a tie between energy and healthcare. 7 of the sectors in the S&P 500 saw margin improvement, while 3 sectors, energy, healthcare, materials, saw margin deterioration. This is doubly impressive when you consider the pressure put on margins by higher wage gains because of inflation, and companies are still able to make margins look better. Most analysts expect this trend to continue in quarter 2, 3, and 4 throughout the rest of this year. So we'll continue to monitor that to see if that is a big driver to bottom line growth for publicly traded companies. How about point number 3? Are you in the market for a new to you car? The MUVVI stands for the Manheim Used Vehicle Value Index. It's an indicator created by Manheim to measure used vehicle prices. The index is based on an analysis of their database of millions of used vehicle transactions each and every year. And it's designed to remove the influence of changes in the types of cars being sold. So it reflects the price trends of the used car market itself, not just the fact that different cars are being sold this year compared to the types of cars that were sold last year. This year, too many BMWs versus last year, too many Hondas. Manheim's latest report released this week showed wholesale used vehicle prices experienced a notable decline in April, extending a downward trend observed over the past year. And you can see that on the CPI chart we're showing on your screen right now that tracks used car prices. The Manheim Used Vehicle Value Index dropped to 198.4, marking a significant 14% decrease compared to April of 2023. This decline was particularly pronounced on a year-over-year basis, with prices falling across all major market segments, including luxury vehicles, SUVs, compact cars, midsize, and pickups. Now, retail used vehicle sales also witnessed a slight decline in the month of April, showing about a 4% decrease compared to the month of March. However, this decline was offset by a 9% year-over-year increase. So month over month down 4, but year-over-year up 9. The average retail listing price for used vehicles increased by 2% over the last 4 weeks, indicating some resilience in demand despite the overall sales dip. Additionally, used vehicle days supply increased to 45 days at the end of April, indicating a modest increase in availability of used cars to purchase compared to the previous month and a slight decrease compared to April of 2023. Overall, new vehicle sales saw a 3.3% decline year over year in April, with volume dropping by 9.1% compared to March. This seasonally adjusted annual rate for new vehicle sales reached 15.7 million, representing a 0.4% increase from last year, but only a slight uptick from March's 15.6 million level. Fleet sales declined by 5.6% year over year, leading to an estimated 17.5% fleet market share, down from 19.3% in April of 2023. Basically, this indicates a shift towards more retail purchases of new vehicles as opposed to corporate or enterprise buying a lot of cars. And lastly, seasonally adjusted electric vehicle values experienced a 17.5% decline year over year in April of 2024, while non-electric vehicles declined at 13.1%. However, EV values have held up better than non-EVs, with a 2% decrease against March of 2024 compared to about a 3% decline for non-electric vehicles. All that to say, if you're in the market for a new-to-you vehicle in the near future, now might be a great time to buy. And finally, point number 4, let's dive a bit deeper into the continuing and initial claims for unemployment insurance that we talked about in point number 1. The weekly jobless claims in the U.S. surged to their highest level in over 8 months, reaching 231,000. This 22,000 increase represents the largest jump in nearly 4 months. While seasonal factors may have contributed to a part of the rise, it adds to a growing evidence that the once tight labor market that was hot is gradually easing, hopefully coming into a soft landing. Continuing claims, as mentioned in point number 1, saw a modest increase of 17,000, bringing the total to 1.785 million. This increase suggests a slight slowdown in hiring activity, but it is important to note that the overall unemployment rate remains at an impressive 3.9%. Now, there are several factors that are contributing to the cooling labor market. The first of which is the Fed's aggressive interest rate hikes. Their goal, their objective is to try to combat inflation by slowing down and dampening economic demand. And it seems to be working a bit. Additionally, surveys indicate that there's a slowdown in hiring sentiment among businesses as they weigh concerns about the economic outlook. And despite the rise in jobless claims, Wall Street's markets still have reacted positively to all this data at the end of this week, with stocks trending higher Thursday and Friday. This may reflect the market's belief that the labor market's adjustment is a necessary step towards curbing inflation and achieving a more sustainable economic balance. Now, of course, the Federal Reserve is very closely monitoring the labor market data and is expected to consider a potential easing of interest rate hikes 2 or maybe even 3 times this year. As of right now, the CME Group is betting that it's going to be 2 interest rate decreases throughout the rest of this year, particularly if inflation shows signs of moderating. However, we must emphasize that it is premature to declare the start of a new trend just based on one weekly data. That's why we look at this data every single week. If you go back on our weekly videos, you'll see every week we're looking at the initial claims for unemployment insurance to say, what do they look like? How is the front end of the labor market, the people that are going on unemployment for the very first time, what's that number look like? Is that number graduating? If it's graduating, is it a trend or is it just a blip? As of right now, it's just 1 week. We'll continue to watch it, and that's why you should continue to watch this video series every single week. So thank you for watching this week's video. If it was helpful, would you do us a favor? You can do us a favor by hitting the like and subscribe button. The like button helps us with YouTube, Google, and Rumble's algorithms, and the subscribe button allows our content to be pushed out to you as it's released, which includes our Question of the Week video series, our What We Learned in the Market video series, and our monthly webinar we do for our clients, including this month's webinar that'll be all around estate planning, helping you understand what you should be doing around wills, trusts, financial and healthcare power of attorneys, and everything that goes along with that. We have an excellent guest estate planner that'll be joining us. So if you can watch that live, that'd be great. Talk to your financial advisor to get an invite for that. And if you'd like to catch the replay, subscribe to our YouTube channel where we will post it a few days after the actual event. As well, you can go to the comment section of this video and schedule a meeting with any of our financial coaches and advisors. Our coaches help you in baby steps 1, 2, and 3. And our advisors help you in baby steps 4, 5, 6, so you can eventually get to baby step 7, where you can live and give like no one else. Thanks so much. We'll look forward to seeing you next week.